Alan Waxman, thank you so much for being here, the CEO and co-founder of Sixth Street Partners, which has about $74 billion in AUM. Now, the uniqueness of your firm is that you're really in all aspects of the finance universe. You've got direct lending, infrastructure, growth, real estate, insurance, sports teams. You really span the gamut. So I just want to kick things off kind of high level and get your take on what you're seeing in the economy right now, given just your perspective across the capital structure, across industries, across different areas of finance.
Yeah, well, let's just step back just for a minute on Sixth Street, because I think it will inform kind of how we look at the world. So our whole investment strategy is we're not prescriptive about anything. We approach every investment, every theme with a white sheet of paper. And we're not private equity, we're not private real estate, we're not infrastructure, we're just investors. And our favorite thing to do, and I think this will inform your question, is to be able to sit down with someone, a company, typically a CEO, ask them questions, figure out what they're trying to solve, and then we try to provide solutions for whatever their needs are in a flexible and scalable way. And that's why we're able to do that, because of the flexibility of our capital. So I just want to level set on that. Within that, really the two biggest things that we're seeing right now is one related to the evolution of the financing markets, and secondly, what's happening right now with the consumer. So evolution of the financing markets. If you go back, the last 20, 30, 40, 50 years, typically all the activities around financing companies have been done by banks. And as a result of what's happened, really due to regulation, because of what's happened with taxpayer bailouts, but also importantly because the private markets, private capital markets, are increasingly providing more capital into traditional banking activities. And they can do it in a more flexible, more scalable way. So when you go to a small to medium-sized enterprise and you ask that CEO what do they want, it's not a cookie cutter solution, it can create solutions. So that whole dynamic right now, the evolution of the financing market, changing away from what was predominantly all banking activity, now to more private market activity, that is a mega theme that's really hitting across all asset classes, from corporate finance, the way corporates are financed, those small, medium, large-sized companies.
You mean public corporates?
Public, private, it's real estate, it's infrastructure. The whole plumbing of the system and the way it's financed is evolving in a pretty accelerated way.
Do you think that all the capital that's gone into the direct lending space and the private credit space, some people have criticized that as being, the potential for a bubble. Is that what you see, given just your perspective on the space and your view of competitors as well as your own book?
It might be a bubble, but it doesn't pose systemic risk. And that's the important point, because a lot of, at least the way Sixth Street does it, is our capital, it's long dated, so we can match assets and liabilities. It's highly flexible. So it's a good thing for small to medium-sized enterprises, because we can sit down, like I said earlier, we can talk to them, figure out what their needs are, whether it's a small to medium-sized enterprises or someone that has a real estate asset, and provide a more flexible, efficient capital. So I think that's a good thing.
So without a systemic risk, you don't believe that more regulation will find its way into this area, because some of the bank CEOs would say that they're so overregulated. They're basically handing business over to the non-bank financials to do all of the lending, but without the systemic risk component to it, regulation probably isn't likely to follow.
Look, the way we think about it, we view it as an evolution. The way we think about it's a win-win-win evolution. The taxpayer benefits because they're no longer going to have to do bailouts because it's distributed risk. Our institutional investors benefit because they're looking for longer dated capital. They don't have short-term deposit holders. They're looking for longer dated investments. And most importantly, to keep the country's economy moving in the right direction and continue to grow, it's better for smaller, medium-sized, and larger enterprises across all asset classes, because it's more flexible, more scalable capital. And it's not really cookie cutter solutions, so it could be customized exactly to what they're looking at. So we view it as a win-win-win evolution, is the way that we think about it. And for banks, they get more focused on higher profitable businesses and also taking less risk. So that's why we think about it as kind of a win-win-win evolution of the financing markets.
Let's talk about the consumer. You mentioned that as being another aspect of what you're looking at with regard to the economy. We're in a world where the excess savings rate is being quickly wound down. Student loan repayments are approaching as well. You've got maybe some tick up in initial claims. what does that all mean for kind of the health of your borrowers and the health of the overall economy?
Yeah. The way we think about it, everyone always talks about inflation, what's going to happen with inflation. Everyone's always saying, is there going to be a recession? Is there not going to be a recession? This question, it's a great question. This is sort of going to unveil the answer key to what's happened next. And what I mean by that is if you go back peak COVID, cumulative excess savings for the consumer peaked at $2.5 trillion. And what's happened really since then till today is that every month that consumer is basically drawing down those cumulative excess savings every month. And it's about to go negative for the first time. So this gives consumers the wherewithal to buy new services, new streaming services, new goods, maybe do a remodel. That's sort of, people have been so surprised about why the consumer has been so resilient. Well, this is why. It's because they had so much cumulative excess savings. But what's about to happen, what we think is somewhere in the fourth quarter, maybe it gets to the first quarter, is that cumulative excess savings is going to go negative. So what happens is people start to draw on credit cards, which you've started to see the draws start to increase.
Delinquencies.
Well, we haven't actually seen them. Actually, the core consumer has been pretty resilient because everyone's got a job. Everyone feels like unemployment's so low. But what's going to happen once it goes negative? What's going to happen to demand? And how does that demand, if there's a slight reduction in demand, how does that roll through the economy? How does that roll through revenues? How does that roll through earnings? Or is it going to withstand that because there's so much growth, and obviously there's a new push from a lot of the stuff happening with artificial intelligence. But what's going to happen after fourth quarter once it goes negative? That's going to start to unveil what's going to happen. And obviously if things stay strong, it's going to be probably harder to bring down inflation. But if things start to weaken, obviously creates more of a recession risk, which, by the way, we don't think, it's hard to call right now what's going to happen. That'll obviously start to tamper down inflation, obviously allow the Fed to take more aggressive actions cutting, which is not a good thing. But that is literally, when you say what is one of the most important things we're watching, that's one of the most important things we're watching is when cumulative excess savings going negative sometime in the fourth quarter.
So you don't think there's a recession?
We don't know. It's so hard to call right now because the economy is really strong, and if anything, it's starting to sort of maybe even pick up a little bit of momentum. But what we haven't seen sort of the turnover of when that cumulative excess savings goes negative, because that will have an impact on, given what percentage the consumer is of the U.S. economy, it will have an impact. And is it going to be minor? Is it going to be major? We don't think it's going to be major. We think it's going to be minor, and we think we'll be able to get through that. But it's really hard to call because we're about to venture into new territory.
So are you urging your borrowers, your portfolio companies, your partners to be more conservative because of this uncertainty? And what does that mean, for the prospect for CapEx and for hiring and other engines of the economy?
The word we use is prudent, because there are growth opportunities out there. So be prudent. If you see really high return on capital growth opportunities, pursue those. But like anything, everything is a fan of outcomes. It's a fan of probabilities. And I think as part of that, we share all our macro views with all our companies and all our CEOs. They have to be looking at that and really plan for that scenario. And if that scenario happens, they've got a playbook. If this scenario happens, they have a playbook. And what we like to do with all of our companies and all our CEOs is to have them ready for whatever happens next. And that's how we think about it. And that's just being a prudent and recognizing the world is nothing is certain. It's basically a stream of probabilities, and that's kind of the way that we think about everything.
Do you think at this point in time the world is adjusted for higher for longer interest rates?
I think maybe from a mindset shift, but actually one of our big themes is what we call capital structure reality, which is when you look at a lot of the capital structures built by companies, built by real estate assets, they were basically built around rates being zero forever. And if rates come back in and they get cut, then it'll all be fine. But right now, a significant amount of the capital structures in the developed world, and to some extent the developing world, were built for a very different interest rate environment. So as things start to evolve, and if things don't come in, obviously there's going to be, they're going to need solutions, and there's going to be capital needs within that to sort of get them through the next bridge period. Again, it's really hard to call without really understanding what's going to happen with the consumer once those cumulative excess savings go negative, and you start to see what the output is on demand.
So given your worldview right now, how are you putting capital to work amid this uncertainty, amid the lack of clarity with regard to what's going to happen on the monetary policy side, what's going to happen with the consumer? Do you feel like you're kind of hamstrung in terms of?
Look, we're always planning for outcomes. So Curly is thinking if it does go negative, we're going to plan for that outcome. But there's also some resilience in the economy. There's lots of areas there's real disruption happening in a good way. There's lots of growth opportunities. Sports, we've talked, some of our themes, just sports, the whole convergence of sports and technology, very big theme for us, happy to talk about it. The whole thing, capital structure reality, a lot of companies and CEOs are looking for ways to sort of fill in their capital structure to extend their liquidity to be able to get through a point when rates in their mind might go lower. There's live events. We're very bullish on live events. The one thing we learned during COVID is that people actually like to do things. They like to go to concerts. They like to go to sports games. And when you think about we always think about for AI, like what are the second derivative, what are the third derivative, fourth derivative impacts? Well, I was at dinner the other night at a restaurant and I saw 5 people around a table and they're all, they're all on their screen, they're all on their phones, and that people felt that at COVID and now they want something different. I think that's why you've seen the whole live event space continue to grow.
Beyonce, Taylor Swift,
you see it, sporting events. I mean, I don't know if you like soccer. Do you like soccer or?
Well, vicariously.
Vicariously. Okay, yeah, your husband's a soccer player. So we were, down Real Madrid, Barcelona, two of the most globally recognized sports brands in the world. They're playing a game in Dallas, Texas. It's just an exhibition.
Not home turf for either of them.
Not home turf. Not a game of consequence. Just playing each other. 82,000 people. Anyone was there. The energy of that. Taylor Swift. I didn't go. My family went. Apparently, in San Francisco felt like an earthquake. Like the things were standing. Like you can't recreate that energy. And I think as people get more and more of their devices and get more and more sort of on their screens, they're going to be really hungry for those live event experiences. There's a whole bunch of ways to play that. And then the last thing, just to hit it, since I'm on a roll here, is look, growth. You talked about the whole growth space. The transaction volume, I've seen you report on this transaction volume down, 50, 60%. And what's been happening, a lot of companies, they've cut expenses. They're trying to manage their burn, being more cautious, and they're extending the runways. But at some point, you've seen a little bit of a crack in the IPO market. We'll see what happens. At some point, they're going to have to come back and sort of get financing. Obviously, the reason why a lot of them have withheld from looking for new capital is because the valuations aren't quite what they were in sort of 2021. So I think that's going to be interesting. Again, I think that's going to start to play out, or we think it's going to play out in sort of first quarter. And we've already started to see that. And I think some of our competitors in the growth equity space have seen that as well.
So you think we're towards the end of that cycle of companies and investors not quite being able to agree on valuation, and so that will unthaw, or that will create somewhat of a thawing of the IPO market, the private fundraising market? Is that?
I think because we're on a sports theme, I'm going to say we're in the 7th inning. We're not in the 9th inning. So if you think about where's the 8th and 9th inning, we kind of think it's like fourth quarter, most likely first quarter. But we've already started to see a real pickup in our pipeline as people. Ultimately, commerce has to go. You can only extend the runway for so long, and ultimately there are growth opportunities out there. And I think people are starting to look for capital and picking their heads up. And obviously, having the IPO market open a little bit of a small crack, that obviously helps and sort of gets commerce moving again. And our expectation is for 2024, volumes will be higher. I don't want to say much higher. It's hard to call right now, but I would say materially higher than they were in 2023.
Just to be clear, are those opportunities outside of AI? Because so far what we've seen in terms of fundraising and what we've seen even in the IPO market to a certain extent is companies that are either IPO focused or AI focused or AI adjacent are the ones that have been able to really capture the capital. Do you think it expands kind of beyond that niche momentum play?
Yeah, I think those will definitely continue to get funded without question. I think what you're going to see is really the late stage volumes, which fell off a cliff in 2023 where they're down 50, 60%. I think you're going to see a recovery in 2024 on sort of late stage financings. in the growth space.
Okay, let's go back to sports. You brought it up, live events. When people think of Sixth Street, especially outside the finance world, they think of your sports investments because they've been so high profile. You've struck deals with the San Antonio Spurs, Real Madrid, Barcelona legends. Tell us about your vision here and about the secular change you see in this asset class for professional investors specifically.
The biggest way to think about it is if you go back 20, 30 years ago, your husband, I think he's an Arsenal fan.
Yes.
So, 20 or 30 years ago, the only way that he could really interact with the brand is to go over to London, go to a game. Maybe he could buy some merchandise online. And by the way, Arsenal, even though he's a fan, and I know he's also like me from Texas, they don't know who he is. So what's happened is really, accelerated in the last 10 years is a lot of these global brands like an Arsenal, like a Real Madrid, like an FC Barcelona, like a Dallas Cowboys, like a New York Yankees, like soon to be BFC or professional women's soccer brand, which we should talk about at some point. Those, because of technology, because of streaming, because of social medias, instead of just interacting with your fans in that local market, it's opened the floodgates on being able to interact with your customers around the world. The San Antonio Spurs, they have a big European fan base. So being able to interact with them now, some kid in Paris, France, they just got Wembanyama, which we were pretty excited about.
I heard.
That 16-year-old kid sitting in a Paris cafe, eating the croissants, because I think that's the only country where 16-year-olds actually eat croissants, except for my kids, of course. They can sit there, they're eating a croissant, and they're watching their phone, and they're watching the San Antonio Spurs play. You couldn't do that 30 years ago. Now, that's kind of the first evolution. So the technology broke down the doors. Now, the next part of the evolution, the part we're most excited about, is how do the San Antonio Spurs or Real Madrid, Barcelona, or other sports investments, how do they actually know who their customers are? Real Madrid and Barcelona, they have 600 million social media followers. But the reality is they probably only know about 140,000 of their customers. So if you say a company's got 600 million fans, 600 million potential customers, and it only knows about the ones that showed up at the Bernabeu in Madrid or Camp Nou in Barcelona, you'd be like, that seems like a big opportunity. And technology is, without getting into specifics, I think that's unlocking a number of ways to interact with those customers outside of your market. There's all kinds of different strategies around that. One idea, like at some point, 10 years, you're gonna be able to put on a headset and your husband at Arsenal is going to be sitting on his couch here in New York City or somewhere in the New York area, and is going to be able to be in a game at Arsenal. That's going to happen. That's coming. There's a whole bunch of other business or investment strategies sort of around that, and that's what's the most interesting, is really unlocking global fan bases.
Can you lose money investing in a sports team? The reason I ask is because Carlyle's David Rubenstein basically said on CNBC that you cannot. Do you agree with that?
Look, I didn't hear the comment. I think in any investment, you have to consider the possibility and protect yourself for that scenario, even in the most unlikely scenario. And I think you have to think about that as a probabilistic fan of outcomes. But at Sixth Street, like the way that we think about things, when we invest in something, we're one of the few investment firms in the world that protected capital over the last 3 economic downturns. That's obviously something we're thinking about. Would I go as far as say that you can't lose money in sports for a normal investor? I wouldn't say that. What I could say is the way that Sixth Street thinks about things, we're typically able to create opportunities and customized solutions that work for whatever that particular sports team is looking for, but also in a way that protects our investors' capital. So I think it's possible, but David Rubenstein's obviously an incredible investor. I don't know that I would say it's impossible to lose money in anything. Things can happen. That's what no one thought COVID was going to happen, and it happens. No one, you probably ask 100 of the best investors in the world, and they would they say there's going to be a pandemic before 2020 that would basically shut down the whole world? I bet you 100 out of 100 would have said no. So it's all a series of probabilities, and that's sort of the way that we think about it.
Fascinating. Well, it sounds like we've got an interesting and quickly evolving future in the world of sports, in the world of growth, in the world of direct lending and other pockets of credit. We're really glad we got to kind of get in the mind of you, Alan, for the last 15 minutes or so. Really appreciate you taking the time.
Yeah, thank you so much. Thank you for having us.